Good morning and welcome to our first day talking about Chapter 1 in Financial Accounting. You can see this chapter is called Introduction to Accounting in Business. So I do not assume that you know anything about accounting. I don't assume that you have ever taken an accounting class or worked in an accounting field. If either one of those or both of those apply to you, then you're in a really good position. And that knowledge should help you, but everything that you need to know is going to be taught in this class as part of this class. Every chapter has a series of learning objectives. There are some on this slide and on the next slide. So we will start each chapter just going through briefly what the objectives are. And then we'll start with the discussion of the chapter. We will also be using those Cengage See Now exercises as part of class. For most of our chapters, we will do all of the exercises together during class. You still have to submit them for grading. You still have to do them on your own, but the intent is that during class you have your See Now exercises open, and as I'm working on them on the screen, you're also working on yours. And then when we finish the chapter, you will submit those to get the grade entered in the grade book. So it is absolutely critical. You cannot pass this class if you do not have that See Now access. If you don't have it now, that's fine. You can get caught up as soon as you have it, but please do not delay in getting that. If you have any issues, any questions about that, contact me outside of class. I'm happy to help you walk through that and how to acquire it, how to get logged in. Once you log in through Blackboard into See Now, it knows that you're in my class, and so it will show you my assignments and all the due dates and so on. Once you do that, you can use the Cengage See Now app, which might be easier if you were trying to do some of the limited exercises, like the quiz, on your phone or a smaller screen device. Generally, though, especially for exams, it is important that you're taking them on a device that has a reasonable size screen, so that you can see more of the exercises and problems at the same time without having to do too much extra scrolling around. So in this chapter, we're going to talk about what accounting is, what our purpose is, what's the point, why do we do this? Most of you, if not all of you, are likely business majors, and every single business degree from JCC requires 2 semesters of accounting. For one of our business degrees, those are the only specifically required business courses are the accounting courses. So hopefully by the time you finish this course, you'll have an understanding and an appreciation for why it is that JCC requires that you take accounting classes when they don't require that you take a marketing class or a management class or a finance class. So why is accounting required? We'll talk a little bit about that. Then we'll get into the doing of accounting. My preference would be that we spend, once we get through this introductory kind of chapter, that we spend the vast majority of our class time doing accounting, as opposed to me telling you what's in the book or reading to you what's on the PowerPoint. I have no intention of doing that. I do use the PowerPoints as a backdrop to kind of keep us in line or going in order. There are some useful parts of the PowerPoint as far as outlines and diagrams and things like that I find it easier to use during class. I would probably caution against trying to write down everything that's on the PowerPoints, in part because you have access to these PowerPoints as well. They are on the companion website. And if there is not right this moment, there will be later today a link to that companion website right in the Cengage content area. That website is free access. You don't have to sign in or anything. It is out there on the web with no sign in required. So on that website, there are some tools that you may find useful. You may not. If you don't find them useful, you don't have to use them. They're like flashcards for vocabulary and things like that. Some people find that helpful, others don't, and that's fine. Use what you find useful. One of the items that is out there, though, is the student version of these same PowerPoints. So there's no reason for you to be trying to frantically copy down anything you see on the screen, because you can get them directly from there. If you find these useful, if you are a note taker and you find it useful to have the PowerPoints as the frame for your notes, you can print them from that website and print the notes view. So you have the lines, 3 slides per page with the lines to the right so that you can use them to write notes. I would encourage you to do that if you find that useful. So chapter 1 really is the outline or the framework that's going to provide the foundation for everything else we do, basically for the rest of the semester. We're going to talk about what financial statements are and describe the 4 financial statements that all companies use and how they use them and why they do them in the first place. And then the next couple chapters, over the next couple weeks, we'll be talking about how we do that basic accounting part of accounting. And then most of the rest of the chapters will be just taking little pieces of the accounting reports or the financial statements and describing what's on there and how is it calculated and what kind of entries do we need to make and so on. Throughout this whole thing, throughout this whole semester, in every chapter, we will mention the idea of how does ethics come into this. I'm not a big fan of let's spend a chapter talking about ethics, because ethics in business, ethics in accounting is part of every single thing we do. And so I do try to make sure we talk about it in every chapter. And most, if not all, of the chapters in the textbook have a section that talks about the ethics related to whatever that chapter is about. But I don't think it's something you can pull out and just talk about the ethics as a standalone. We spent a day, we spent 20 minutes talking about it in class one day. I don't think that's sufficient. If you have questions, you are welcome to stop me at any time. I do try to regularly stop and say, everybody getting this? Does anyone have questions? But you do not need to wait for me to stop. If you have a question, please just ask. Particularly for people who are on Zoom, if you have a question and you're concerned about interrupting because maybe there's a delay in the sound or whatever, you are welcome to use the raise my hand feature button, and that actually will just put a note on my screen that says so-and-so has raised his hand, and so I will know that you have a question and I will stop. So feel free to use that. Also, because we do have a few people here who were not here last time, let me reiterate one other thing that I didn't say before we formally started class. Although we do have students who are on campus and students who are scheduled to be on Zoom, students who are scheduled to be on campus, if on any given day it doesn't work for you to be here for whatever reason, you don't have to have a reason other than, I was up late because, the Bills were busy blowing the game, and so, I just didn't get up in time to drive here or whatever it is. You're welcome to join on Zoom. The link for Zoom is right in the class. So even though you're scheduled to be on campus, you can join Zoom on any given day. For those of you who are on Zoom, if you are close to the Cattaraugus County campus, and if you meet the governor's mandate as far as being vaccinated against COVID-19, you are welcome to join us in the classroom on any given day, even though you're scheduled to be on Zoom. You just have to do the screening before you can attend any class or activity on campus. You do have to be fully vaccinated, or whatever they're calling fully vaccinated these days. And if it's been more than 6 months since your last shot, you need to have the booster in order to come to campus. Beyond that, I would welcome you to come to campus. And my class is on the Cattaraugus County campus in Olean in the Tech Building, room 207. So feel free to join us if you meet those requirements. Okay. Questions before we actually start talking about accounting? So we're going to be talking about accounting, and as I said, I'm going to hopefully give you a sense of why we require every business student to take 2 semesters of accounting. Why virtually every business degree, I've never seen a business degree from any institution of higher learning that does not require at least these 2 semesters of accounting. And the reason is because you can't get away from accounting. Every single organization, large or small, public, private, not-for-profit, they are all using accounting. No matter what job you have in the future, you're probably going to see accounting, even if you're not doing accounting yourself. And so it is important that you understand what accounting does and can appreciate, even if you don't want to do it, you can appreciate the value that it brings to your business. At a minimum, in the future, you're likely to see things like budgeting as part of your job. You may not be responsible for implementing a budget or for putting a budget together, but you're almost certainly going to hear things like, well, we can't do that because it's not in the budget. Or we have to watch our hours because we're getting close on the budget. Again, every single organization does that. Now, the accounting that we are learning in this class is financial accounting. And we'll talk a little bit about how financial accounting is different than managerial accounting, which is the name of the 2nd semester of accounting that you will take. The textbook that we are using for this class is called Financial and Managerial Accounting. So we cover the first half of the book in financial and the second half in managerial. So for those of you who will take both semesters, believe it or not, by the end of the 2nd semester, you will have covered more than 1,400 pages of the textbook. That's every single chapter in the textbook. So you really get your money's worth from this textbook. When I was a college student, it's been a few years, but when I was a student, it always bothered me when we didn't cover most or all of a textbook, and I would have to read those other chapters. Like there's something good in there. There must be something important, or else why would they put it in the book? So I always wanted to cover all the chapters. You may not be the same, but that is where I'm coming from, that it's all important. It's all really relevant to your future, regardless of what that's going to be, even if it's not going to be in business. You want to go work for a not-for-profit organization, they still have an accounting staff, and they still have budgets, and they still have reporting that they need to do at some level. As I said, we're doing financial accounting, and by financial accounting, I mean the accounting that is required for publicly traded companies in this country. So not-for-profit accounting looks a little bit different, and we're not doing that. Tax accounting looks a little bit different, and you'll hear me mention once in a while that, here's how it's done in tax accounting, but it's different. So you have to be clear that what you are learning is what publicly traded companies are required to do. Why do we have that focus? Because 80% of our GDP is produced by publicly traded companies, by corporations. So even though they make up only about 20% of the businesses. So it is the vast majority of the output of our nation. Those businesses are following the rules, the principles that you are learning this semester. There are 3 main types of business. Now, some businesses do more than one of these 3, but for our purposes, we try to simplify things and look at really that ground level with the understanding that if you get it at that ground level, you can expand on that and make it a little bit more complicated. But the 3 main types of business, you can see on the screen right now: service, merchandising, or retail, you sometimes hear that called, and manufacturing. Our focus this semester is going to be on merchandising organizations or merchandising businesses. Service businesses do not sell a product, they're selling a service. So the accounting has a little bit less complexity to it because they don't have products at all. You can see some examples there, Delta Airlines. Now they give Walt Disney Company as an example of a service business, and certainly much of what Disney does is service, but they also do some selling of product. They have Disney stores, they sell merchandise. So again, there frequently is some crossover in the real world between these three. Merchandising businesses are selling a product, but they don't make the product they sell. They buy it from a supplier. They might be a wholesaler or a retailer. Wholesaler buys from maybe directly from the manufacturer and then sells to other businesses who then sell to the end user. Retail means that you're selling directly to the end user. And you can see, a couple big examples there, Walmart and Amazon. Does that mean that Walmart doesn't make anything they sell? Well, if you go into Walmart, you see that they have a deli and a bakery. So they are making some of the product that they sell. They make sandwiches, they make hot food, they make baked goods in their bakery. I assume they do. So they do a little bit of manufacturing, but mostly they're merchandising businesses. And finally, the most complex of these three is a manufacturing business. So you probably all know what manufacturing means. They're actually making the product that they sell. Ford Motor Company makes the cars, the vehicles that they sell. Merck is a pharmaceutical company. They make the drugs that they sell. In managerial accounting in the second semester, Business 1520, our focus is on manufacturing businesses. But for this semester, we're primarily working with companies that buy the product and then resell it. So what is accounting? Now, I should tell you that I'm not big on memorizing definitions. I'm never going to ask you to spit back to me a definition in the textbook terms or even how I described it to you. I will normally give you a paraphrase of a definition. What's important to me is that you know in your head, you know what it means, even if you can't put it into words. It certainly does not need to be in my words or in the textbook's words. Repeating to me what the textbook says does not tell me at all that you understand what it means. So accounting is really an umbrella term that covers a number of different functions. The purpose of accounting is to help decision makers make decisions about our company, to give them the information they need in a useful format so that they can make an informed decision. So accounting's purpose is to help decision makers make informed decisions. So when you see in these steps here, number 1 through 5 on this slide, when it says identify users, they mean decision makers, people who want to see that information to make decisions. So we can divide those decision makers into two main categories. People who are inside the company, who work for the company, like managers trying to make a decision. How much of that product do we need to have on hand to meet demand? How much do we need to make on Tuesday? How much profit are we going to make? Do we need to be able to borrow money to meet our needs for this month and so on? And then you have external users, people who don't work for the company. Our job this semester in financial accounting is really focused on those external users, people who do not work for the company but are trying to make some kind of a decision about the company. So who might that include? Who outside the company needs to make a decision related to our company?
Rivals.
Say it again.
Rivals.
Rivals. Okay, so our competitors might want to know something about, well, gee, how much does it cost them to make the product? And how much profit are they making? Sure. Sorry.
Our consumers.
Our customers. Yeah,
Customers,
so our customers might. Now, not every customer wants to know something about the company. Certainly our big customers might want to know, are we solvent? Should we really rely on this company to deliver the product that we need? But if you just look at what you're wearing or look around the room where you are at some of the products that you might have around you, my guess is you probably, if you're wearing Nike sneakers, you probably don't know anything about Nike's financial statements, probably. If you are using a Dell computer, you probably don't know anything about Dell or Microsoft or name a company. Probably you as the end user don't need to or want to know much about their financial statements. But absolutely, in some contexts, our customers really do need to know, is this a reliable company? Are they solvent? Are they going to, if they promise a delivery, are they likely to be able to meet that delivery for us? In the classroom here, someone said investors. So as I said, we are talking this semester about publicly traded companies. So when we say investors, we're mostly talking about people who are interested in buying the stock of our company. So they want to know, is the company making money? What's happening with the stock price? Is it going up? Is it going down? Do they pay dividends? Before I open the chat, I just need to say, I didn't say this yet today, so not everyone heard it. Because there is, as you probably know, a way to post in the Zoom chat and make it go to an individual where no one else can see it. That being said, because there are people sitting in the classroom and they can see the screen, when I open the chat, they're going to be able to see what you posted in the chat. So please do not put something in the chat that is private. If you need to get information to me that's of a personal nature, just send me an email, please. Because once I open it, the people who are sitting in the classroom can see it, even if you sent it just to me, because it's going to be on my screen. Perfect, stockholders. So posting in the chat to something that you want the whole class to see, that's always fine. But please do not put something personal in there, because either I can't see it or everyone in the classroom will be able to see it. And that, I just don't want that to happen. So absolutely, current stockholders want to know, how did the company do this year? I gave them my money, I invested with them. How did they use that investment to make money for me? Do they pay dividends? If so, how much? Investors could also be potential investors. So people who, I've got $1,000, I want to invest it, and I'm trying to decide between ABC company and XYZ company. They both do the same thing. They're both in a field that I'm interested in, I support, and I think it's growing, so which one's better? Okay, so investors. Investors could also include, when we get to chapter 11 on long-term liabilities, we'll be focusing on a separate class of people who might be considered investors, and those are people who lend money to the company. So creditors. The way that corporations borrow, publicly traded companies, is typically by issuing corporate bonds. And so we'll focus on corporate bonds in that chapter. But if you're thinking of lending money to a company, even if you're a bank or some other lending institution like that, you want to know, are they going to be able to pay us back? What risk am I looking at here? What interest rate should I be charging? Should I be lending them money at all? Who else might want to know about our company? Yeah, auditors, funders, IRS. So the auditors need to see our financial statements to give them, hopefully, their stamp of approval. By funders, I'm not sure if you mean people who are lending money to the company, or when you're talking about a not-for-profit, they get funding maybe from a government source or from grants, and the granting organizations want to know how stable are they and how did they use that money. So
yeah, that's exactly what I was talking about, because I'm working on nonprofits. That makes me think of that, because they review that before they will honor an award to your agency.
Absolutely, you are absolutely right. But I just need to mention that not-for-profit accounting, although it follows a lot of the rules that we are talking about, it's not exactly the same. And so The rules might be a little bit different. The rules for government organizations are also different. There's a whole separate set of standards for government accounting that do not match up well with what we're learning in this class. So while absolutely the basics apply to all organizations, some of the reporting is a little bit, the requirements are a little bit different. So who else? How about if you work for the company? If you're thinking of, you're graduating from college, let's say, so fast forward a little bit, you're graduating from college, and if the job market is still like it is now, their jobs are going begging, means there's lots of them out there. And so you might be in the really nice position of being able to pick and choose. And maybe you get job offers from 2 or 3 different companies, and you're looking at them going, which one should I take? Which company is going to be around longer? Which company lines up better with my values, and so on. So if you're thinking of working for a company, you might want to know how they're doing. Marcia had mentioned the IRS. They want to know because they want to make sure that you're paying your taxes appropriately. Again, tax accounting is a little bit different. The basics of what we're talking about apply to all organizations, but tax accounting and the way we do tax reporting is, we're not covering that in this class, and it's a little bit different. Sometimes a lot different. Okay. So, decision makers. Big division, people who work for the company, people who don't work for the company. So internal and external users. Internal users, we mostly focus on in managerial accounting or management accounting, because those people work for the company. They have access. They can call Joe in accounting and say, hey, Joe, could you give me a report on whatever? People who are outside the company don't have that luxury. Now, yes, if you are a lender, if you are the IRS, certainly if you're auditors, you have access to that internal information. If you're the IRS, you can request information. If somebody's trying to borrow $1 billion from you, you can ask them a question and they're probably going to answer it. But most of those groups that we just talked about, potential employees, investors, most investors, don't have access to that internal information. And so for those people, for those groups, for those decision makers, they have to rely, excuse me, talking through the mask eventually gets me. Those people have to rely on the information that is publicly made available. And so that's why it is very important, this accounting role, because we as accountants determine what goes out there. And people who are going to use that information to make decisions that are really monumental to them, what job should I take? Or should I invest my life savings in this company or whatever? Need to know that they can rely on that information to make appropriate or correct decisions about that company. Questions so far? So everybody uses accounting, every single company that's out there, whether it's not for profit, for profit, publicly traded, privately held, they all have accounting. And the majority of what we're talking about does apply to all of those companies, regardless of how big or small, where they're located, how they're funded. Things just look a little bit different for different types of companies. But if you're publicly traded, everything that we're talking about this semester applies to that company. This is one of those diagrams I was saying for some people might be helpful. I'm not so much of a visual person, I'm more of a numbers person. But you will find these types of diagrams and flowcharts sprinkled throughout the textbook, and they may be helpful for you. Of course, you have access to the ebook through the CNOW, through the Cengage app, and I would encourage you to take a look at those if you find those particularly helpful. But here's the internal and external users. Our job as accountants is to look at what's happening in the company, determine what needs to be entered into our accounting records. We then process that information. We produce reports that hopefully are going to be helpful for these decision makers. And then we communicate the reports. And in some cases, we take the feedback from those reports and maybe incorporate that into our next accounting record. As I said, managerial or management accounting, those two terms really mean the same thing. We call it managerial accounting when we name the class, and that's what this textbook refers to it as in the title. Managerial accounting is aimed at those internal users. It's a little bit more flexible because, as I said, you can just call Joe in accounting and say, hey, Joe, could you get me a report on what happened last Thursday? And Joe's going to give you that information. A little bit more flexible, a little bit more forward-looking. And put a couple terms on the screen. I can find that annotate function here. So financial accounting is retrospective. Retro means backward, means in the past. Spect refers to looking or seeing, like a spectator or spectacles. Sometimes people call eyeglasses spectacles. Retrospective means backward looking. Financial accounting is by requirement retrospective. We are reporting on what happened in the past. Management accounting or managerial accounting, on the other hand, can be prospective or forward-looking. We're trying to help people inside the company make decisions about what to do next, what comes next. So management or managerial accounting includes things like budgeting and forecasting and things like that. Financial accounting is not permitted to be forward-looking. We are required only to talk about what happened in the past. Now we realize, of course, that decision makers are not trying to make decisions about what happened last year. They're trying to make forward-looking decisions, and we're trying to help them. But we cannot say, and next year we think this is going to happen. There's one exception to that. In the annual report, you will find something called the MD&A. I'll put it on the screen. So it's the management discussion and room there, analysis, or MD&A. So in the management discussion and analysis, or MD&A part of the annual report, that is the only place, and sometimes you might see it called the letter to the stockholders or something like that. In that, which is just a piece of the annual report, the company is permitted to say, and here's what we're doing next. Here's what's going to happen next year. That's really the company's opportunity to tell you, here's what happened last year. Here's our explanation why maybe things didn't go the way we wanted it to, but here's why. And here's what we're doing to improve things or to make our company bigger, better, more profitable in the future. The financial statements themselves cannot include any forward-looking information. By requirement, we have to simply report on what happened in the past. And we recognize that decision makers are trying to use that information to make forward-looking decisions. So we want to make sure we give them information that is valid, that it's reliable, and that it has predictive value, that it's going to help them make decisions about the future. What we are going to be doing then is learning to prepare general purpose, GP, general purpose financial statements. Remember I said if we're a potential investor and we have $1,000 to invest and maybe we're looking at ABC company and XYZ company and we're trying to compare. So we need to make sure that when we look at the financial statements that they make publicly available, because they have to, that they're comparable, that they're using the same rules, following the same guidelines, so that when we compare ABC to XYZ, we're comparing apples to apples using that that expression. I'm going to skip through this. As I said, we will continue to bring up the ethical issues as we go through each chapter. As I said last week, you are required to read what's in the textbook. I'm not going to try to tell you everything that's in the textbook. We're going to cover about 700 pages of the textbook. So I don't have time in class, nor do I wish to tell you everything that's in there. If you read about something in the textbook, whether I've mentioned it in class or not, if you're not sure what it means, if you have a question, please ask during class. You're welcome to do that. But I'm in no way trying to tell you everything that's in the textbook. As I said, I would like the focus of our time together, which is very limited. We have 30 classes for the semester, but the first one was introduction. The last one is wrap up and review if needed. That means we have 28 classes that we're covering new material. That's 2 classes per chapter. We cover 14 chapters. That's a lot of work to do. So, and I don't want to spend time telling you what's in the textbook that you should have already read. But please make sure you ask if you don't understand what you read. So I already explained ethics is a really important, very, very important part. We need accountants to be trustworthy because the external decision makers, the people who these financial statements are meant to help, we have to believe and trust that they're accurate, that they are accurately portraying what's happening inside our company so that we can make a good decision. Well, back in the 80s and 90s, there are a number of very well-known accounting scandals where the accountants may have been doing a few things that maybe they shouldn't have been doing. And the result was that the financial statements that were being produced by these companies, and the big ones that most people maybe have heard of, Enron, WorldCom, HealthSouth, in this area of the country, Adelphia Communications was a big one because many people worked there and lots of people were negatively impacted by what happened inside that company. Those scandals led to an erosion in the public confidence or the public trust in accountants, which led directly to what you see on the screen right now, which is Sarbanes-Oxley or SOX or Sarbox. This is an act of Congress named after 2 gentlemen, a senator and a congressman who were the prime sponsors of the act. And it was meant to restore public confidence in the accounting profession and the result, the product of accounting, which is those annual reports or financial statements from a publicly traded company. So we've had accounting rules and principles for decades that we are following. Sarbox or SOX changed a little bit of that. We'll talk about that a little bit more when we get to the chapter on cash and internal controls. I'm not going to dwell on that now, but the Sarbanes-Oxley Act was a big deal. It changed fundamentally the relationship between a publicly traded company and the auditing firm. An auditing firm used to have much more of a cozy relationship, and now it is required that they have more of an arm's length relationship so they can be a little bit more objective. I don't want to spend a lot of time talking about that, but I would encourage you, if you're interested, make sure you read what's in the book. And if you have an interest in learning more about that, just Google it. You'll find lots of articles. If there's an interest, I would be happy to post a couple articles as well that kind of describe the changes that came from Sarbanes-Oxley and how it impacted the accounting profession. The important part was, prior to those accounting scandals, when you looked at one of those surveys about the most trustworthy professions, Accountants used to be near the top of the list. And when those accounting scandals were hitting, guess what? We fell way down the list. And so since the implementation of the Sarbanes-Oxley Act, accountants thankfully have risen back up. And I think it should be clear why it's so important, because external users, as I said, only have access to the information that companies provide publicly. And so in order for our market system to continue to function effectively, we need to have confidence that that information is reliable and accurate and trustworthy. And if we think that the accountants who are producing it and the auditors who are reviewing it are not trustworthy, we're not going to trust that information either. One of the advantages of the corporate form of organization, I'll put this on the screen as well, is what's known as the ease of capital generation. Oops. Monday. Ease of capital generation. Investors have access to the capital markets, and the markets are efficient in getting capital from investors who want to invest to the companies that are worth it, that are a good risk, that are a good way of investing. Corporations have access to the capital markets in two main ways. They can sell stock. We'll talk about that in chapter 12 on stockholders' equity. But we've already talked about the importance for investors of knowing about the company to decide whether to invest and how much to invest. And corporations can also enter the debt market. And we'll talk about that, as I already mentioned, in chapter 11 on long-term liabilities. The biggest way that corporations access credit is by issuing corporate bonds. And so that's our main focus in that chapter. Well, think about what would happen to companies, to publicly traded companies, if investors were no longer willing and able to invest because they didn't believe the information that was out there. It wasn't trustworthy and reliable. It would not bode well for our current way of doing business. Wouldn't bode well for the market economy. So it is important that we are ethical, and you can see on the screen a few different guidelines for behaving ethically. The accounting profession has ethical standards that are publicly available, and you're welcome to look at those. I think the IMA, the Institute of Management Accounts, theirs might even be in our book in a later chapter. But we need to use our personal ethical standards of honesty and fairness. Think about, how does this decision impact others? What obligation do we have to our company and to the public? And make a decision that is ethical and fair to those who are affected by it. Again, you can read more about this in our book. It is likely that most people in this class are here because you're a business major, but may not be looking at accounting. Some of you at the end of the semester might change your mind. You might be saying, oh yeah, accounting, I really enjoyed that. It fits with what I want to do. It's how my mind works. And some of you may not, and that's fine. Not everyone can be an accountant, and not everyone wants to be. So as I said, my goal for this class is that you get to the end with an understanding and an appreciation for why accounting is important and how you might be using it in your future job, career, even if you have no intention of being an accountant, just to understand what the accounting, the financial statements are telling you is a really valuable tool. But for those of you who do want to be an accountant, there are a few different types of accounting, of course. There's public accounting. In New York State, in order to sit for the CPA exam to become a certified public accountant and work for one of those auditing firms we've mentioned, you need to have the equivalent of a master's degree, and then you need to take the exam. And once you pass the exam, you need to work under a licensed CPA for a period of time before you are actually a CPA. So you can be CPA eligible because you got the education and you met you passed the test, but you're not actually a CPA until you have some experience as well. Although it is a national exam, every state makes their own requirements about what is needed to take the exam, which has always struck me as a little strange. So if you live in Pennsylvania, which some of you may, if you live in Pennsylvania, the requirements that you would need to meet to take the exam are different. And I will let you look that up on your own, but if you're interested in that and want help to talk about that, please feel free to contact me. I'd be happy to talk about that with you. If you are thinking of moving to another state, you would also want to look at their requirements in order to be a CPA there. I'm not aware of any states that have higher requirements than what New York State currently has. Okay. I would encourage you, JCC has a career website as part of, and I can't, just the name just went out of my head. But if you go to the My JCC webpage, you'll find a link there for it, and you'll find easy access to information about careers and current salaries and so on there. So I would encourage you to take a look at that. Career College Something Network. It's College Something Network, and I apologize, I just totally lost what it was. College Central Network, maybe? So what are we learning this semester? Well, what we are learning, as you know, is the rules or principles that guide the financial statements for a publicly traded company. And what you see at the top of the screen right now is what those are called, GAAP, Generally Accepted Accounting Principles. These are the principles for publicly traded companies in the United States. Other companies, other countries have their own standards. There is something known as IASB, International Accounting Standards Board, that sets international standards, but I do not want you to think the US has one set of standards and all the rest of the world follows the international standards. That is not the case. Many countries choose to have their own standards. There are many countries that follow US standards. In order for a company to be publicly traded in the United States currently, they have to follow international standards, although we are in the middle of a very long convergence project to sort out some of the differences between the international or IASB standards and ours. The group that sets our accounting standards is known as the Financial Accounting Standards Board, FASB, it's pronounced FASB. So the FASB in the United States sets our accounting standards. They don't just throw them out there and see what sticks. It's a very lengthy process to change any accounting standards, and they seek input from all of the interested parties. So all those decision makers that we were talking about earlier have the opportunity for input if the FASB is considering an accounting rule change, because it affects a lot of different groups. Oh, and there it is at the top of the next screen, the FASB. And I mentioned the IASB already. In the United States, the Securities and Exchange Commission, or SEC, has oversight or authority. Their job really is to protect the investing public. It is a government agency. And so their job is to make sure that the information that's being put out by publicly traded companies is reliable and accurate. If you wanted to go public, the SEC would have to give permission for that, along with the state in which you are incorporating needs to give permission for that incorporation. They need to approve it. You can read through these if you have not already. Read through these terms, but all of these terms are important as the the underpinning for what we are doing. Okay, we need to make sure that the information that's out there is believable, that it helps us make decisions. That's really what it comes down to. And those characteristics of financial accounting help ensure that. Some additional terms, and then we'll, before we run out of time, I'd like to get to at least a couple exercises for today. So we have a concept in accounting known as money measure. Money measure means that when we put stuff into our accounting records, we're going to denominate it in terms of its financial impact. And so because we are in the United States, our financial statements are going to be in dollars. So when we report stuff in accounting, it's in dollars. The concept of business entity means that when we do accounting, we are accounting only for the transactions that affect the business. It needs to be a separate entity from the customers, from the suppliers, from the employees, that what goes into our accounting records is only the transactions of the company. Now, from a legal standpoint, that may not be true. So there are three main business organization structures in the United States. There are others, but these are the kind of the original and the main types. Sole proprietorship means that there's one owner. A partnership means that there are two or more owners. They may be equal or unequal partners. And then there's the corporation. The corporation has stockholders. You can be a corporation without being publicly traded. Interesting fact, in New York State as well as in Pennsylvania, if you are incorporated, it is a requirement that you include in the title of your business the term corporation or incorporated, INC, so that everyone knows that your company is incorporated. Doesn't mean you're publicly traded. From a legal standpoint, sole proprietorships and partnerships are the same as the company. There is no legal distinction. Now, as I said, there are some additional types of, so you may have heard of an LLC or an LLP, limited liability. What that means is, yes, there is a legal distinction. But for a sole proprietorship, if I just want to open a bakery and I just put up a sign and start selling stuff, I am most likely a sole proprietor. And from a legal standpoint, the business and I are the same thing. Okay. A corporation is a separate legal entity. It can own property. It can sue and be sued. It is a person in the eyes of the law. That is not true for sole proprietorships and partnerships. As I mentioned a little bit earlier in class, 80% of the businesses in this country are sole proprietorships, roughly, but 80% roughly of the output of our economy comes from corporations. Where there's, as far as output, it's something like 12% comes from sole proprietorships and 8% from partnerships, or something, roughly those numbers. So we focus on corporations, in particular publicly traded companies, because they make up the vast majority of our economy. And statistically speaking, most of you will likely be working for a corporation later in your life. Or now. Okay, let me just skip through these. The concept of going concern means that we assume, unless we have evidence to the contrary, that our business is going to continue, it's going to last forever. Corporations, because it is a separate legal entity, can have an unlimited life. A sole proprietor in partnership, if one of the owners, if the owner or one of the partners decides that he or she no longer wants to be a part of that business, the business essentially goes away. The owner of a sole proprietorship dies, there is no more business. Now the assets still exist, but the business is the sole proprietor from a legal standpoint. If you own stock in ABC company and you pass away, your heirs will become owners of that stock, but it won't affect the company itself. If you own stock in XYZ company and you don't want it anymore, you can sell it. Again, doesn't affect the running of the company. So we assume for a corporation, unless we have evidence to the contrary, that the business is going to keep going and going and going, and it's going to be around for 100 or 1,000 years. It could, in theory. But for our accounting purposes, we have to break that going concern into smaller chunks. And so the way we normally do that is accounting for what's known as a fiscal period. All publicly traded companies are going to set a fiscal year, which is generally a 12-month period or very close to a 12-month period. Sometimes it's a calendar year, so January 1st to December 31st, but more often than that, it is a period that is chosen by that organization. If the company has a slow time of year, that's probably when they will end their fiscal year. Excuse me. So we have to break up what's happening, and you'll hear this again when we get to chapter 3. We have to break up what's happening into smaller chunks so that we can report, because people who are trying to make decisions about our company need information in a timely fashion. They can't wait until the business is done to find out what happened. So we use this concept known as periodicity. Which means that we're going to break what happens in our business into shorter, more manageable reporting periods. For a publicly traded company then, although they're probably doing their accounting on a monthly basis and reporting internally, they're going to report to the public on a quarterly basis. And then on an annual basis, they're going to report for the whole year, and those reports, those financial statements, will be audited as part of their annual report. The quarterly reports are known as interim financial statements. And then we have the annual report. The interim financial statements are not audited. And they might be a little bit less precise than the annual reports. You can see 4 principles there on the screen, and as soon as I talk about these, we need to get to our exercises. So if you have not already, while I'm talking, please go into See Now and open the chapter 1 exercises if you have access to those. So measurement, historical cost, and revenue and expense recognition. Revenue and expense recognition will really be the focus of chapter 3. Let's talk about measurement. So we want whatever we're measuring, we want to be objective and verifiable. We are going to determine whether something is a transaction, which means it affects the financial position of our company. And if so, we need to record it and report it in our accounting records. The historical cost principle means that we are going to record things basically at what we paid for them. We're not trying to value them based on current market conditions, but we record things in our accounting records at what we paid for them. And that amount is generally not going to change throughout the life of the asset. We'll get to revenue and expense recognition in chapter 3, as I said. Let's go to our exercises. Now, as I said at the beginning of class and last week, most of our exercises we will complete together during class. For most chapters, we do all of them. But there are some exercises that are not very beneficial, in my opinion, for us to do together for a couple different reasons. So, and this is one of them. This is the very first exercise in chapter 1, make it a little bigger. And if you look at this, you can see it's essentially a multiple choice question. So for each one of these companies that's listed, and most, if not all of those company names are going to be familiar to you. So for each one of those companies, you have to think about what type of company it is and choose from the list which type it is. So we define those terms: service, retail, and manufacturing. You can tell if you look at them, if I hover over, there's something special there. If I hover over those green terms, you can see that it pops up a definition for us. So that's very beneficial as well, to remind you what each one of those types is. I'm going to ask you to complete this on your own because I just don't find it helpful or a good use of our time during class. And here's why. Because I'm going to click the check my work button, and it's just going to tell me if the answer is correct. And so if the answer is not correct, you can just change it. I get that I'm not naive. I get that you could just go right down the list and put them all in manufacturing and hit the button. And then if it didn't come up with a green check mark, it comes up with a red X. And that tells you it's wrong. And then I can, oh, let me just try the next one down. I understand you can do that. That's not very helpful. It will not help you learn this. There's nothing I can do to prevent you from doing that, but I strongly discourage it. Please use the check my work button as it is meant to guide you after you've tried to do the exercises on your own. But because we've already talked about these and it is then just a multiple choice question, I'm going to ask you to finish that one up on your own outside of class so we can move on. So at this point, we have talked about a lot of the background stuff about accounting, and we're ready to actually start learning how do we do this. Okay, we know why we do it now. How do we do it? So we're going to start with something called the fundamental accounting equation. And this right here, whoops, I don't know why that's supposed to be a box. I apologize. Get rid of that. It's supposed to be a box. That's what I was trying to do. So what I just boxed in is known as the fundamental accounting equation. So what does it mean if something's fundamental? Like the foundation, right? It is what underlies everything we do. I will put this on the screen for the next few class periods, probably just to remind us. If we were all in class, I would write it on the board at the beginning of class just to remind everybody. You'll notice it is also, and I had showed you this for people who were here last class, I had showed you in the reference materials folder, just ignore that box for a minute. There's that intro video, the video from last class. And I gave you these, I showed you these two items and said we would get to those. This accounting equation is expanded, so it goes a little bit beyond what I just boxed for you in that exercise. But you'll notice it is assets equals liabilities plus the stockholders' equity is this whole thing. So we will be learning in chapter 2 the rest of the story here, the rest of what goes on there. But you do have this here for reference to remind you of that equation, and I will continue to remind you in class. So from math class, an equation means there's an equal sign. It means that what's on the left-hand side of that equal sign has to be the same in total as what's on the right-hand side. This equation, just like in math, if we know 2 of the pieces, we can find the third. So it is never in accounting going to be the case that we know 2 of these and have to find the third. The only reason we do it in this exercise is just to help you see how the pieces fit together. Assets, as you can see when I hover over it, are the resources owned by a business. And I would go a little farther than that. It's stuff that the company owns or controls. Because sometimes things show up on the balance sheet as assets that the company doesn't actually legally own, but they have use and control of them. For example, Southwest Airlines, you may not be aware, doesn't own any planes. How can that be? They lease all of their planes. They don't own them, they lease them. And so the planes themselves can still show up on Southwest Airlines financial statements because they control them, because they have a legal contract that says, yep, those planes are yours to use for this period of time. Liabilities represent amounts that the company owes to people outside the company, to their creditors, debts and other obligations. They've borrowed money. They took a shipment of product from their supplier and they haven't paid the supplier yet. They owe their employees for work that's been performed. They owe the government taxing authorities for taxes that they have collected and not yet submitted. So those are liabilities. Giving you a bunch of different examples. And then stockholders' equity is the owner's share of the assets of the company. It's kind of like if you own a house, the asset would be the house itself. And let's just say, I'm just throwing numbers out there. Let's say, because it's a nice round number, that the house is worth $50,000. But you borrowed money from the bank. You took out a mortgage to buy the house, and maybe the mortgage is $30,000. So the house is worth $50,000. You owe the bank $30,000. Your equity in that home is $20,000, right? And that's where the concept of a home equity loan comes from. You're borrowing against the part that you have already paid for, that you owned free and clear. That's not encumbered by that mortgage. Works the same way for a business. The asset is a list of all the things they own. The liabilities are a list of all of the amounts that they owe, and the equity is what's left. It's the residual. It's what's left. So if we know the liabilities and equity for letter A here, we know the liabilities and equity, what must be the total assets be? How would we find that? We would just add the liabilities and equity together, right? Just like any other addition problem. 550,000 plus 1,345,000 is $1,895,000. Everyone agree with that? So we could find the total assets because we knew the value of the other two pieces. Again, it's never going to be the case that we know the liabilities and the equity, we have to find the assets. That's not how it works. But this type of exercise is helping to reinforce this is an equation, they have to be equal. How about for letter B? We know the assets, 776.5, and we know the equity. How do we find the liabilities? We take the total assets, 776,500, and we subtract the stockholders' equity. And that will be our liabilities. If you have not already, go ahead and do C on your own. And then once you're done, you can click the check my work button. Should have all green check marks. Also, you'll notice down at the bottom of the assignment, bottom left-hand corner, you can see your score. There's 10 exercises for each chapter, so each exercise is worth 10% of the grade. Even though some of the exercises take longer and are bigger than other exercises, they each have the same quantity or the same percentage, 10% of the grade for the assignment. So just like with the pre-quiz, there's no reason to submit your assignment until you've achieved the score you want. You can always tell if you have finished an exercise. If you look at the little dots next to the exercise, if it's white, it means you haven't started that exercise. If it's half green, like exercise 1 is here for me, that means it's started but not completed. And then once it's completed and you got full credit, you have the white check mark in the green background. You can also use these to navigate around. So if I wanted to, for some reason, skip ahead to exercise 9, and we will occasionally go through the exercises out of order. So if I wanted to go to exercise 9, I just click on that. So you can click around, you can go back to the exercises an unlimited amount of times. Do not hit submit for grading until you're done with all the exercises. We're going to be still working on these exercises on Thursday, so you don't want to hit submit for grading. It's going to save whatever you have in there. Don't hit submit for grading until you are done. Because it'll probably happen if you accidentally hit submit for grading. You just need to let me know and I can reopen it for you so that you can keep working on it. Same thing's true for the pre-quizzes and the problems. Any questions so far? Okay. So let's go to exercise 3 and we'll keep moving. On Thursday, we'll be able to spend pretty much all of our class working on the doing part of accounting because we've got all of that talking stuff, most of it out of the way. So in our accounting records, we have units of storage called accounts. An account is the smallest record, individual record. And in each account, we capture the effects of stuff our company does, known as transactions. We capture the effect of those transactions on those individual accounts. What you see here in letters A through F, these are all known as account titles. Account titles. And that account title should be short and sweet, just a couple or a few words, as few as possible, to explain what that account is used for. So we already know the definition of an asset, a liability, and an equity account. This is also a multiple choice question, and so normally I would say do this on your own, but I want to be able to talk about what each of these types of accounts is. Now, many of you, most of you will end up working for companies that are very different maybe than the examples that we use in class. And so in class, we try to be as simple and generic as possible so that when we use account titles, we're using ones that are pretty widely applicable, that most companies might have an account like that. It is not possible, of course, for us in class to cover every single possible account title that's out there in every single type of company that exists. The goal is that we give you that foundation so that what you learn in here, the principles of accounting, you can expand and apply in a real world situation. That being said, the titles of these accounts, the 6 accounts that you see in this exercise, are used by pretty much every company out there, with the possible exception of fees earned. So accounts payable. Anytime you see the word payable, it means we owe someone and we're going to pay them later. Payable means we owe someone and we will pay that bill later. So anytime you see the word payable, you should immediately be thinking, oh, that's a liability. We owe someone. Accounts payable is a liability. Other types of payable accounts include things like wages or salaries payable, income taxes payable, insurance payable, property taxes payable, benefits payable. Accounts payable is used typically for when we've when we purchase things from our suppliers and we just haven't paid the bill yet. Purchased on credit and haven't paid the bill yet to our suppliers. So it could be, where do we buy our inventory? It could be, where do we buy our supplies and things like that. A receivable is exactly the opposite of a payable. It means someone owes us and they will pay us later. So the opposite of a liability is an asset. Anytime you see receivable, it means somebody owes us. We've allowed someone maybe to buy on credit. Accounts receivable is used when we allow our customers to purchase the product or service that we sell on the agreement that they'll pay us later. So accounts receivable is used when our customers haven't yet paid. We gave them, maybe we gave them 30 days to pay or 10 days to pay or whatever. And we'll talk more about that concept of payment terms in chapter 5 when we get to the the merchandising operations chapter. Other types of receivables include things like interest receivable or notes receivable. When someone borrows extended for an extended period, they're going to pay us interest. But accounts receivable is generally reserved for just our customers buying on credit. Now, fees earned. Fees earned is a special kind of account. I really don't like that phrase, don't like that account title, fees earned. But what it means is it's a total of the revenues. I'll put that word on our screen. It's a total of the revenues, which is basically the amounts that we charge our customer for what they buy from us, the product or service that we provide to them. So fees earned means our customer, we've done something for them. We provided the service, we sold them the product. So the difference between revenues and accounts receivable, revenues is the total amount we've earned this period. Accounts receivable means that's how much they still haven't paid us the cash. We'll talk more about that again in chapter 3, the concept of revenues and the difference between earning the money and having received the cash. But for now, revenues is a part of stockholders' equity. Remember I showed you that expanded accounting equation? If you're in doubt, you can look here. Revenues comes under stockholders' equity. The amount that we earned from our customers, from whatever we sold them, product or service. Supplies represents the supplies that we have on hand. So as I look around the classroom here, I see lots of supplies. I see a stapler that has staples in it. The staples are supplies. There's a printer over here that has paper in it and a toner cartridge. Those are supplies. There's a dry erase marker and a dry eraser, Post-it notes. Those are all supplies. Supplies are things that we use in the normal course of business and they get used up, but they're not sold to our customers. So we use them in the normal course of business. The supplies account represents the amount that we currently have on hand. So it's an asset. Assets are things that we're going to use to run our business, to help us make money. Supplies needs to be distinguished from merchandise, and the nature of our business tells us whether something might be a supply or merchandise or some other type of asset. So Staples sells Post-it notes and staples and paper and toner and stuff. So for them, the stuff that's out on the shelves might be merchandise inventory, where for me, it's a supply that I use in my business. And so we need to distinguish something that's for sale to our customer is inventory, even though for another individual or entity, it might be a supply. A vehicle that's used in a business would be a long-term asset. But if you're a car dealership, that same vehicle that's for sale is inventory. So we need to be careful. We have to know something about how that product or merchandise, that piece of equipment or whatever is being used in the business. I'm aware we have just one more minute, so let's see if we can finish this up. Supplies expense represents the cost of what we have used up in running our business. And if you look at that expanded accounting equation, you'll see expenses as part of stockholders' equity. The more we spend to run the business, the less we have left inside the business. Anytime you see a revenue or an expense, those are going to be part of stockholders' equity. We're going to stop there for today as we are about to run out of time. Any questions? Go ahead and click the check my work if you've finished that one, get your credit, but it will save what you've done. As I said, don't hit submit for grading until you're done with all of them. When we come in on Thursday, then we'll be able to jump right into our exercises after answering any questions you might have. So we'll start with exercise 4. And we should be able to get through on Thursday all of the remaining exercises. If not, you will, not Thursday, Wednesday. I apologize. I meant Wednesday. Our next class is Wednesday. So Monday, Wednesday, this class is. So On Wednesday, we should be able to get through all the rest of them. If not, you will be given extra time. We will finish them likely on Monday in class, but we should be in good shape for Thursday, for Wednesday. Any questions before we call it a day? All right, thank you all for being here. See you on Wednesday.